As Wall Street sits near record levels, Main Street is still struggling. The divergence may be due in part to the government's uneven response to the coronavirus crisis in terms of, at least recently, the efforts to have an additional stimulus package. Steve Leisman takes a closer look at the split economy. Steve.
Thanks, Joe. Yeah, many big companies have prospered in this pandemic in part because they've been able to leverage technology, taking market share from smaller businesses, and because they've been able to cut costs in ways small businesses just can't. But government programs may be widening the advantage of big companies, helping drive down their cost of funds in the crisis. The Paycheck Protection Program made some $660 billion available to small businesses. It did a good job of getting money out the door relatively quickly, but was not targeted at the hardest hit areas where the virus had spread the most. Millions of small businesses were helped, along with some that probably shouldn't have been, but they were forced to keep their employees on the payroll. The program awaits new funding at this time. Big companies are getting help from the Federal Reserve and the Treasury with no strings attached. Take a look here. The Fed's corporate credit program has bought $12 billion in public corporate debt, but its effects is much larger, backstopping much of the corporate debt market and even helping stocks. It's helped spark massive new debt issuance at very low rates. Corporate debt issuers pay nothing for the Fed's backstop in the secondary market and have no restrictions. The Fed's Main Street lending program, aimed at medium-sized companies, has booked just $470 million in loans. While these loans are interest-free initially, they do carry a 3% rate over 5 years, and banks have to retain 5%. The take-up has been slow because critics say it's too expensive and banks don't want the risk. So the biggest companies enjoy a much lower cost of capital, in part due to a broad Fed backstop for their debts. Medium-sized companies have to pay interest. For the smallest companies, there's no money available right now, and the money that was offered came with strings attached, Joe.
Trying to figure out the solution. You highlighted the problem, Steve, and you know what? You can see exactly how it happened, too, can't you? I mean, it's almost and like why, in the response. Yeah, go ahead.
And why, Joe? Yeah, because it's much easier for the Fed to go into the corporate debt market. It's very hard for it to go into the small, to really backstop small business loans. But you think about it, if you're going to create programs that segregate companies by size, you want to make sure that the cost of capital ends up being at least similar, or the aid provided by the government to reduce the cost of capital. Ask yourself this question, Joe. For the next crisis, would you much rather go in as a small business or as a big business that is available and potentially have the Federal Reserve or the Treasury backstop your business? There's definitely an incentive created to be bigger from this response.